Every single financial decision we make is really just a bet on a future we can't see. I mean, whether you're stashing away cash for retirement or you're managing a massive fund, the problem's the same. How do you make the best choice when everything's so uncertain? Well, it turns out financial analysts have some seriously powerful tools to cut through that noise, and we're going to dive right into them. Just think about it for a second. You're facing a choice like this, a real high-stakes situation. Sure, your gut might be screaming one way, but how do you get past just a feeling? How do you actually weigh that amazing upside against the chance of losing everything? This is the exact puzzle that analysts have to solve, day in and day out. So, to see how it's done, we're going to tag along with an analyst looking at a really tricky investment, a bond that's already in default. This means the company couldn't pay its bills, and the bond's now trading for like pennies on the dollar. So the big question for our analyst is there some hidden value here? Is this a diamond in the rough, or is it just a guaranteed way to lose money? Okay, so her first move is to slice through all that complexity and find one single number she can use as a starting point. To do that, she needs to figure out the bond's expected outcome. She starts with this really foundational idea called expected value. Now, I know it sounds super technical, but the concept is actually pretty simple. You just list out everything that can possibly happen, figure out the odds of each one, and then you calculate a weighted average. It's an amazing way to take a messy, uncertain future and boil it all down to one single, useful number. So look at how our analyst breaks down the problem here. She figures there are really two main economic situations that could play out. Scenario 1, which is the likely one at a 75% probability, has its own set of potential payouts. And then there's Scenario 2, less likely at 25%, where the payouts are a lot lower. You can see how every single possibility has a value and a probability tied to it. After she crunches all the numbers, weighting each possible payout by its specific odds and adding it all up, she gets this. The expected recovery is 75.5 cents for every dollar of the bond's original price. This is her anchor, her first logical, data-driven guess at what this thing is really worth. But here's the thing. Expected value is great, but it can also be a little misleading. See, that 75.5 cents, that's not actually one of the possible outcomes. It's just an average. The real result could be as high as 90 cents or all the way down at 40. So to make a really smart decision, she needs to see the whole map. And that brings us to the next tool in the toolkit, to actually visualize all these different branching paths into the future. Our analyst uses something called a probability tree. It's a fantastic way to lay out all that uncertainty so you can actually see it. All right, let's build this tree out together. The very first branch is the biggest question mark. What's the overall economy going to do? So we split the path. We've got Scenario 1 with a 75% chance of happening and Scenario 2 with a 25% chance. This is our starting point. Now let's go down that first path. If we're in Scenario 1, the branch splits again. There's a 45% chance we get 90 cents back and a 55% chance we get 80 cents. See how the picture of what could happen is already getting so much clearer? And finally, we just map out the possibilities for Scenario 2. If the economy tanks, there's an 85% chance of getting 50 cents back and a 15% chance of getting only 40. And there it is, the full map of possibilities. Now she can see every single potential path and its likelihood, all in one glance. So the map is great, but let's be real. The world doesn't just sit still. New information is coming at us all the time. A really great analyst has to be able to react to that new information. And this is where we get to ask the powerful question, what if? So let's play this out. Imagine a huge economic report just dropped, and it's fantastic news. So good, in fact, that our analyst is now basically certain we're in Scenario 1. That 25% chance of a bad economy, it's gone. It's zero. So how does that totally change her calculation? For this, she uses a tool called conditional expectation. It's really just a formal way of saying she's going to recalculate the expected value, but she's only looking at the future that's now possible. She's finding the expected value given the condition that we are definitely 100% in Scenario 1. And look at the result. Her original valuation was 75.5 cents. But now, by focusing only on the possibilities within that good economic scenario, the new conditional expected value jumps all the way up to 84.5 cents. This is so important. The value of the investment literally changed because her knowledge about the future changed. This whole process of updating what you think based on new evidence is one of the most critical skills in finance.
And, well, there's a formal mathematical way to do it using an incredibly powerful formula called Bayes' formula.
This idea is captured perfectly by this famous quote. It's not about being wishy-washy, it's about being rational. And Bayes' formula is basically the engine that drives rational thinking. Okay, let's look at a totally new problem to see how this works. Our analyst is looking at a different bond. Based on history, she thinks it has about a 20% chance of going bust. That's her starting point. But then she runs it through this fancy computer model, and the model spits out a good rating. So how should this new piece of evidence change her initial 20% gut feeling?
The logic behind Bayes is actually beautiful and simple. First, you start with what you already believe. That's your prior. Then you get some new piece of evidence. You figure out how likely that new evidence is. And finally, you combine your starting belief with that new evidence to get a new, updated belief. That's it.
All right, let's look at the ingredients for the formula. Her initial belief, her prior, is that the probability of failure is 20%. The new evidence is that good rating. Now, she needs to know two more things from historical data. First, what are the odds of getting a good rating if a bond is actually going to fail? That happens 50% of the time. And second, what's the overall chance of any bond getting a good rating? That's 70%. With these numbers, she's ready to go.
She plugs those numbers into Bayes' formula, and this is what comes out. Her belief that the bond will fail drops from 20% all the way down to 14.3%. So the good rating didn't make the risk disappear, but it did systematically and logically lower her estimate of it. That's precision.
So, after all that work, what did our analyst really accomplish? Well, she's moved way beyond a simple gut feeling to a sophisticated, multi-layered understanding of this investment and all its possible futures. She's built a complete toolkit. She started with expected value to get a baseline number, then she used a probability tree to visualize every single possible outcome, she used conditional expectation to see how new information changes the game, and finally, she used Bayes' formula to formally update her beliefs when that new info actually arrived.
But here's the thing, these tools aren't just for financial analysts. They're a framework for thinking clearly about any uncertain future, whether that's a career move, a big business decision, or even a personal project. So that leaves one question. Now that you've seen the toolkit, what uncertain bet in your life could you start to see just a little bit more clearly?